So welcome back everybody to the second video of Basics of Accounting. So as I've already given my introduction, I'm Professor Mayuri Tavre from PAS Modern College of Engineering. I teach to an MBA department student. So many of the students have again requested into the first video also I've mentioned that many of the students are from non-commerce background. So they are not able to understand what accounting is probably, and this series of video is specifically from the for the non-commerce students who are pursuing MBA, right? So let us start with this second video. So the glimpse of the particular video, I mean the video number 2, which we are doing today. So uh, first is we are going to see what are the forms of business organization. Into the first video, I have cleared the concept of debit, credit, and all. Now we are going to move towards the balance sheet terminologies, income statement terminologies, then some general statements, and some transactions we are going to see for references, how you're going to understand the transactions, how you're going to read the transactions, how you're going to solve the transactions. Then some quiz link, which I have shared in my previous video also, and into this into this video also, I'm going to share 3 links for this particular video. So let's start. So these are the common forms of business organization which are found in India. So the left hand side, will start from the left hand side, which is sole proprietor, that is unlimited liability of the owners. Then partnership businesses. So into it, if we see sole proprietorship business is what is being taught in the managerial accounting course for MBA students. So sole proprietorship means a person, whole and sole owner of the business. He's the manager, he's the recruiter, and he is the risk taker, as well as he enjoys the profit, everything a sole proprietor, a sole person does. So that is why it is said as sole proprietorship. It's mere the business can be started by mere a shop act license, which is given by the corporations, municipal corporations. So it is that easy to form that particular business in a very small place at a very narrow level. You can start this type of businesses. So more talking about the unlimited liability part of the owners. So since just one document, that is Shop Act license, is needed for starting this particular business. So unlimited liability here means the liability is unlimited to the extent of owner's property or owner's assets, not just business assets. So for an example, if I am a person who is starting a grocery shop, in that case, I would say that I'll start my grocery shop, and if somehow I couldn't manage or I couldn't be successful in that particular business, so I am liable personally as well to pay off to my creditors. That means my own property in my name, not just business name, but my name property is also taken away for paying off the debt of the creditors in that case. That is what is known as unlimited liability. Then partnership business. Partnership business are again started by two people who are into who just want to start a very small business again. So here we can see two concepts altogether, that is partnership business and limited liability partnership. So these two concepts are very different. Please do not get confused with it. So partnership business is something where two people are coming together and they are just starting a business, like a sole proprietor. So that is how it is. Then second comes limited liability ownerships. Into it, private companies are there, private limited companies are there, public limited companies are there. Now, under Companies Act 2013, one-person company is being now introduced. Then cooperative societies are there. Section 8 company, that is NPOs. non-profit organization is there, and other, I can list many more. That is, NBFC is also there, and cooperative society is already mentioned. NBFC is also considered one of the company uh, under the Companies Act. So, private limited company, if we say, uh, many of the definitions are being given, and into detail it is being explained in the Companies Act 2009, 2013, as well as in 1956. Detailed explanation were given into this. So, basic features of private limited company, I'll just let you know. Basic characteristics of a private limited company, I'll let you know. So when forming any kind of a private limited company, minimum two people are needed, two members are needed. One can be a director as well as one can be a promoter. Or for forming any kind of a private limited company, two directors are mandatory while signing the MOU, and one proprietor can be there. So afterwards, you can extend it. This is the minimum requirement, right? And maximum members can be 200 now, as per the Companies Act 2013. And when you are forming a private limited company, uh, mentioning PVT Ltd, that is private limited, is essential in front of any kind of a company. For an example, if I'm saying that I'm forming a company which is Manisha Limited, right? Manisha Private Limited. So that is how the company's name has to be there. Then second comes public limited company, which issues the shares. When we say that an IPO is coming in the market, okay, so that is the process where the company becomes a public company. So you're issuing your shares to the common public, to the common people. You're calling them for the subscription of your shares. That is the initial process of a private limited company becoming a public limited company. So again, the members for a public limited company, minimum members are 7, essential while signing the MOUs, while establishing a company, and maximum there is no limit. Uh, and when you form a public limited company, basically it doesn't have to be mentioned PVT. It can mention only LTD, that is limited. So public limited means, for an example, if I'm saying that I'm forming an Ashok limited company, so that is Ashok limited, not private limited. So one person company and sole proprietor is again a similar type of business, where we can say that one person company has one director as well as one promoter. So the promoter and director cannot be the same person, but yes, one person forms the company. And the main difference here is one person company doesn't just start merely getting a shop act. No, like sole proprietor did. No. So one person company has to get registered under the Companies Act according to the norms, rules, and regulations, or the formation of a private limited company. Similar to that, one person company can be formed. And in front of one person company, you have to always mention OPC, PVT, LTD. That is one person company, private limited. So it is again a private limited company. After that, if a one person company wants to get public, it cannot get directly public. It first needs to get converted into a private company, and then it gets converted into a public limited company. So cooperative societies, again, into Marathi, we say Patha Samsthas. So cooperative societies are none other than the societies which operate by the Cooperative Society Act. And the rules and regulations, members, chairperson, they all are as per the norms which are mentioned by the Cooperative Society Act. Then Section 8, company, NPO, again, it is formed under the Companies Act. So it is non-profit organization. So the name itself says everything. So the companies which are not formed for the mere profit purpose are said as non-profit organizations. So how does it differ from limited? I mean, then what is the concept of limited liability of owners? So into the Companies Act, the very first definition of any of the companies given is the business is different, is distinct from its members. So distinct from its members means the business has its own identity and the owners has its own identity. So they are not mixed together like sole proprietorship. That means I cannot claim the property, the personal property of the member of all of these companies. They are distinct. They are separate from the companies. The owners are separate from the companies. So the very famous case of Selman versus Selman into the business law, you can refer to that. Then you will be able to understand the concept very clearly. Then comes the joint Hindu family business, which is again falling under unlimited liability of main owner. Now, what does the main owner is said? He is said as Karta, and the other members are said as co-partners. So in this case, when we say that unlimited liability of the main owner into joint Hindu family business, so again the taxation differs. The Karta is the main person who takes whole and sole decisions of the company, and it is basically an ancestral business which is carried forward from generation to generation. It doesn't has to get transferred with any kind of a legal norm. So the next generation by default becomes the karta of the business. Then comes limited liability partnership, unlimited liability of negligent partner. So in this case, when we say that limited liability partnership, the word itself says that the liability is limited to the partner's contribution to the business. So only the portion what I am contributing as a partner into the partnership firm, I am liable only for that particular percentage of share what I am contributing. And same wise, I am responsible only for that percentage of profit, which whatever the partnership is owning. So in this case, if we say that CA firms, CS firm, architect firms, these are all said as limited liability partnership firm. So I hope this all the forms of business organizations, I have tried to give a glimpse of it. You can, if you have more interest, you can go and read about these particular forms of business organization. So let's look to the basic terminologies of the balance sheet. So what are the terms into the balance sheet? So accounts payable, when we say accounts payable into the last first video, I have explained this. I'm going to explain this again. So accounts payable includes all of the expenses that a business has incurred but not yet paid. So this account is recorded as a liability to the balance sheet side as it is debt owned by the company. So when we say that the expense is incurred. So for an example, I have done a transaction on credit basis today. Today I have bought some goods, some kind of a raw material for my business, and in next month I'm going to pay the particular amount for that raw material. So in this context, I will write for this month in my accounts payable the amount, the expense which is already incurred. Accounts receivable is a vice versa of accounts payable. So accounts receivable includes all the revenues that a company has provided but has not yet collected payment on. So the company has already sold certain goods on credit basis and it has not yet received the payment from the debtors. So that is what is said as accounts receivable. Accrued expenses, an expense that has been incurred but hasn't been paid, is described by the term accrued expenses. So the expense that is being incurred but hasn't been paid. So in that context, if we say that outstanding salary, right? So that is something, or uh, that is what outstanding rent. Okay? So these are said as accrued expenses. Okay. So assets, anything the company owns that has monetary value, these are listed in order to of liquidity from cash, the most liquid, to the land that is least liquid. So an asset is something what we say that the company owns and has a certain monetary value for it. So balance sheet, a financial statement that reports on all of the company's assets, liabilities, and equity. As suggested by its name, a balance sheet abides by the equation assets is equals to liabilities plus equity. So book value, what do we understand by book value? As an asset is depreciated, it loses value. So the book value shown is the original value of an asset less an accumulated depreciation. So here the two terms are being introduced, which is said as depreciation and which is said as book value. So let us first understand what is depreciation and then probably we'll come back to the book value. So in this context, what is depreciation? So for an example, if I have purchased a land or I have constructed a building for my business. So its life gets, degraded or depreciated. So in that context, it is getting utilized on yearly basis. Okay, so the infrastructure is getting utilized of that particular building on daily basis. So its value is getting down. So what is the book value now? So for an example, the cost of the building is 1 crore, 1 CR, and it is not going to remain in my books. Okay, in my books, 1 CR till I sell it. No, I need to depreciate the value of the building as per the utilization. So in this context, depreciation are bifurcated into two. Depreciation has two types. One is straight line method and one is return down value method. So when we say it is a straight line method, so for an example, my value of the building is 10 lakhs today. Okay, when I have purchased it. So that is set as my book value. So I'll upfront, if I am charging 10% depreciation on that 10 lakhs. Okay, so the value comes down to 1 lakh. So 10 lakh pay, 10% is 1 lakh. So next, my book value becomes 9 lakhs for the next year. Again, I'm charging 10%. This is straight line method. Okay. So again, I'm charging 1 lakh. Then the value is getting degraded to 8 lakhs. So the 9 lakhs, 10 lakhs, 9 lakhs, and 8 lakhs, what we are getting the amount, it is set as book value for that particular year. So in that context, when we say as a return down value method, return down value method doesn't consider only the percentage of fixed, the amount doesn't remain fixed. Amount keeps on changing in WDV method, that is return down value method. So how does amount gets changed? Again, we'll take the same example, that is 10 lakhs. 10 lakhs ka amount this year, again charging 10% depreciation on it would be 1 lakh. The balance remaining is 9 lakhs. So next year, I'll be charging not on the 10 lakhs, but on the 9 lakhs. So 9 lakhs, again, I'm going to charge 10%. That will become 90,000. And after that, from deducting, it will remain probably 8 lakh 10,000. Again, on that, I'll be charging 10%. So my 10% value will be 81,000 for the next year. This is the concept of return down value method. And whatever amount we are getting after deducting the depreciation, so that is the original value of the asset of that particular year. Equity. Equity denotes the value left over after liabilities has been removed. So recall the equation asset is equals to liability plus equity. If you take your assets and subtract your liabilities, you are left with equity. So which is the proportion of the company that is owned by the investors and your owners. Inventory, it is the term used to classify the assets that a company has purchased to sell to its customers that remains unsold. As these items are sold to customers, the inventory account will lower. So in this context, for an example, I'll give you the example of an inventory that I have produced for this day, 400 units. And next day I have produced 500 units. So out of my 400 units, only 350 units are being sold. So 50 are remaining. So what does it becomes? It is a finished product, it becomes your inventory. So next lot, if I am planning to produce 500, I need to produce 450 only, because I'll add my inventory, the remaining goods which are unsold, into the next calculation. Okay, that is what is said as inventory. Liability, all debts that a company has yet to pay are referred as liability. Common liability, including accounts payable, payroll, and loans. These are said as or overdraft facility or outstanding expenses, whatever we have, they are considered as liability, including equity. So income statement terms, income statement is none other than profit and loss account. So it is also said as income statement also. Okay. So cost of goods sold. Cost of goods sold are the expenses that directly related to the creation of product or services. Not included in the category are those costs that are needed to run the business. For an example, cost of material, direct labor to provide a service. These are the expenses which are not directly included into any kind of a business, but they are essential to run the daily business operations. Depreciation, as I have already told you, depreciation is a term that accounts for the loss of a value of an asset over the period of the time. So generally, an asset has to be substantial value in order to warrant depreciating it. Common assets to be depreciated are automobiles and equipments. Depreciation appears on the income statement, that is profit and loss account, as an expense, and is obtained categorized as non-cash expense, since it doesn't have a direct impact on the company's cash position. So profit and loss account में depreciation को what we say, it is shown as an expense. It is shown on the debit side of the profit and loss account, and it is a non-cash expense, so it doesn't have any kind of an impact on the cash balance of the business. Expenses, that is a cost, it is incurred by the business. So for an example, if I'm buying a stationery also today, so that is my expense. If I'm buying any kind of essential goods for my business, that is again my expense. So gross margin is a percentage calculated by taking gross profit and dividing by revenue for the same period. So if you divide your gross profit by revenue, you will get the gross margin for that particular period. Gross profit indicates the profitability of the company in dollars. So without taking overhead expenses into account, it is calculated by subtracting cost of goods sold from revenue for the same period. Income statement, that is again said as profit and loss account. So it is a financial statement that shows the revenue, expenses, and over the period of time, all other aspects, that is income as well as expense. So revenue earned. So net income, what do we understand by net income? So expenses is given for a particular period, including cost of goods sold, overheads, depreciation, and taxes. So it is calculated by taking revenue and subtracting all the expenses, which is said as COG, overheads, depreciation, and taxes. So net margin is the percentage amount that illustrates the profit of a company in relation to its revenue. It is calculated by taking net income and dividing it by revenue for a given period of time. So revenue is any money earned by a business. So let us understand what are the general terms which are in accounting. So accounting period, as I've already told in the first video, that there is a certain accounting period where the income statement, balance sheet, and profit and loss accounts are made on that for that particular period. So allocation, what do we understand by allocation? So allocation describes the procedure of assigning funds to various accounts or period. For an example, cost can be allocated over multiple months, like in the case of insurance. Allocation over multiple departments like administrative, HR, marketing, operations, and all other production departments. That is assigning the funds to that particular department. So business or legal entity, if we say this is the legal structure or type of business, common formations like sole proprietor partnership or LLP, what we have already seen in the previous slides. Cash flow statement is the term that describes the inflow and outflow of the cash in the business. So the net cash flow from a period of a time is found by taking the beginning cash balance and subtracting the ending cash balance. So in this context, if we say the beginning cash balance is 1st April 2023, which is the last balance, which is the opening balance, and the closing balance would be on 31st March 2024. Then on 1st April 2024, the opening balance would be the closing balance of 31st March 2024. So credit, we have already seen a credit is an increase in liability or equity or a decrease in an asset or an expense. Debit, so a debit is an increase in an asset or an expense account and a decrease in liability or equity. Diversification is a method of reducing risk into the mutual funds. The diversification concept is used where the risk is diverted into multiple portfolios. The portfolio is one, but in the portfolio, the companies are different, which diversify the risk of that particular fund. Then fixed cost. A fixed cost is one that does not change with the volume of the sales. For an example, rent hai, salary hai, they won't change according to the output of the business. For an example, if I am manufacturing 400 units today and tomorrow 500 and after that 300 units, so my salary won't differ same with the units I'm producing, right? General ledger, it is basically a ledger which is being created after journalizing the transaction. So that is what it is said as general ledger. Generally accepted accounting principle, we have already seen what are they. So these general rules were established so that it is easier to understand apple to apple when business financial reports are produced. Interest is the amount paid on a loan or line of credit that exceeds the repayment of the principal balance. And then journal entries. Since when I am mentioning journal entries, so journal entries we are going to see at the end of the videos how we journalize the transactions. So every journal entry must consist of a unique identifier, a date, a debit credit amount, and account code that determines which journal entry has to go further into the ledger. Liquidity, a term referring how quickly something can be converted into cash. For an example, stocks are more liquid than a house since you can sell stock, turning it into cash immediately. Material. So material is the term that refers whether information influences decision. For an example, if a company has a revenue in billions of dollars, an amount of 0.50 is hardly material. So GAAP requires all that material consideration must be disclosed. On credit, on account, a purchase which is happening on credit, on account is a purchase that will be paid at a future time, but the buyer gets to enjoy the benefits of these purchases immediately. Brander puts it on my tab. Overheads are those expenses that relate to running the business. They do not include expenses that make the product or deliver the services. So overheads often include rent or executive salaries. Then comes payroll, is the account that shows payment to the employee, salary, wages, bonus, and any kind of a deduction. Present value is the term that refers to the value of an asset today. So, and opposite to a different point in time. So it is based on the theory that cash today is more valuable than cash tomorrow. So what is the value of my asset today? That is more important. So receipts, a receipt is a document that proves payments are made. So if I go to a particular grocery shop, I buy certain goods, I get a receipt of it, okay, the bill of it. That is what is said as receipts. So it is a document which gives a proof that you have made the payment for buying something. Return on investment, originally this term refers to the profit that a company was making, that is the return, dividend divided by the investment required. So today, the term is used more loosely to include returns on various projects or objectives. So if a company spends $1,000 on marketing, which produces $2,000 in profit, the company could state that ROI on marketing spend is 50%. Trial balance, it is listing of all accounts in the general ledger with their balance account. So after we generate journal, after we generate ledger, after that the trial balance is being prepared. Variable cost, there are costs that change with the volume of the sales are the opposite of the fixed cost. So these are the costs which are opposite of the fixed cost. So for an example, if a company produces a product and sells more than that, they will require more raw material in order to meet the increased demand. So over and above, the variable cost will change. Today I'm producing 100 units, tomorrow I need to produce 150 units. So according to the production of the units, the cost will vary. That is said as variable cost. So let us see the illustration one by one. So it's a company, Orange Limited. It has the following transactions. So basically it deposited 10,000 into bank. So the cash has been deposited according to the golden rules, what is coming in and what is going out. So the cash has been deposited into the bank. So who is the receiver in this case? If we say an artificial person is the receiver, so the bank is the receiver. So we are going to debit the bank in this case because debit the receiver. And what is going out from the business is cash. So bank account debit to cash account. This is the ideal entry for it. It buys goods. So let us see the explanation of the uh, transaction. So account involved our bank account because bank is the receiver here, and in the next context, cash is going out from the business. Both are real accounts. So what is coming in and what is going out. So second transaction is it buys goods worth rupees 50,000 from Apple Limited. So we are receiving goods. So we are going to debit the purchase account, right? And credit the Apple account because Apple Limited is the giver. So let us understand in the context of a table. So purchase goods, your Apple Limited nominal account, that is an expense account, and Apple Limited, that is a personal account, who is the creditor of the account. Let us understand the next transaction. That is, it sells goods worth rupees 35,000 to Melon Limited. So who is the receiver in this case here? Melon Limited. And what is going out from the business? That are goods are going out. So Melon account debited to sales account. So personal account is the data and sales is the nominal account, which is the income for the business. Then pays rupees 12,000 as rent. So in this context, if we say that rent is a nominal account and bank account is the real account, which is an asset account. So you need to apply where I have written real account, nominal account, personal account. You have to apply the rule there. What is the rule of real account? What is the rule of nominal account? What is the rule of personal account? So into debit, into credit. You need to apply, as I've already told in the first video itself, that there could be a combination of golden rules. It is not essential that real account will be debited and real account will be credited. No. On rupees 3,000 as interest on bank account, that is interest received, and bank account, that is interest received is the nominal account, which is an income for us, and bank is the giver. So in this context, real account, that is bank account, is credited. So these are certain quiz link. I'll just open you for the references. I'll post it in the bio for your reference, so you can attempt the quiz. So this is debit and credit quiz, as I have shown in the previous videos also. So you'll be able to see this kind of tests when you open the link, right? So there are certain questions which you can answer. This is a self-explanatory. Should the 500 entry to the cash account be debited? So yes or no. So a company received 5,000 of cash as an additional investment in the company by its owner, Mary Smith. The company's cash account is increased and Mary Smith capital account is increased. So it receives a cash. So yes, it should be. That is the right answer. So cash is always debited when cash is received. So these are the platforms where you can test the knowledge after you see this video. And I would recommend you to please go on this links and test your knowledge. Unless and until you practice this, you won't be able to get what exactly you have understood from this particular video. So this again is the bookkeeping. Concepts of bookkeeping, what we have seen in the first video, and then comes the accounting principle, again what we have seen in the first video. I've mentioned the link here into this second video because the concepts are more clear now, and after this I'm going to come up with a third video as well. So small versions of all the concepts I'm going to make sure for everybody. And do not fear about managerial accounting. It is a very easy subject. It is very technical subject. I mean, the tricks, if you understand of the accounting, it is very easy and you will enjoy, you will start loving managerial accounting. I'll make sure. Thank you so much, everybody, for watching the video. See you in the next video.